Hello and welcome to the channel. My name is Patrick and today we're going to look at where Bitcoin are in its cycle with consideration to Euler's natural exponential. I'll also look at a little bit how I use this for setting up trades, how I think about that, and we'll also do a quick follow-up on something I mentioned in yesterday's video regarding the sloping lines and how to predict the next small reversal top. But first, as always, none of the content in this video or any other video are for anything else than informational and educational purposes. There is no financial advice or any other type of advice shared in this video. Before we jump to Euler's exponential, I just want to do a follow-up on yesterday's video. If you saw it, remember that I showed how these sloping lines, when we break out from them, we do not go to the moon or anything. The fact is that if you draw a triangle, you cannot really have a breakout from the sloping line. It's only the horizontal line that you can have breakouts from. That simply is because Bitcoin doesn't know that we have drawn a sloping line. You might then correctly argue, does it know we draw a horizontal line? Well, it knows because we have a lot of liquidation levels and they're always horizontal, they're not sloping. And once we hit those, other people form or panic sell, and big players sometimes use these moves to put more fuel on the fire to get the market where it wants it. And they use then liquidation levels and people's form or panic to drive the market where it wants it. So most sloping lines, when we break them, we do not get any breakouts. Basically, we showed how we could predict where this reversal will be, where this reversal will be, and where this reversal would be. And now I've gotten some new data, so let's look how this applies for it. Because the best way to validate ideas is always when you get new data, because it's quite easy to fit all kind of crazy ideas to historical data. They may not do anything at all to predict the future. Most often they don't actually. So look here, we have now kind of a sloping trend line, and this is on the 4-hour chart on Bitcoin. It's easiest to do it on the 4-hour chart. And we broke this line. So does this mean that we got a breakout where Bitcoin got to the moon? Now apparently didn't. Where were we supposed to go according to the rules I talked about yesterday? Well, somewhere between and this top. And isn't that where we ended up? Right between them, as expected. And if we go up again, the next is expected to be between this top and this top. And if we do not do that, if we get a candle going through them like this, which of course will happen sooner or later, this is not a 100% rule, but often we have 4, 5, 6 of these break of sloping lines where we follow this rule and do not go to the moon or anywhere else. And before we have a breakout of the actual horizontal line up here, that is a real breakout, we usually get a candle that goes through. It doesn't end up with expected. Here we expected to turn around where we did, and then we would expect to turn around in this area next time we break this level here. But if we don't and go above it, well, that is usually the first sign that we now will attempt to break out from this shopping sideways pattern we have been in for a while. So that was just a quick follow-up since we got a new of these patterns just 24 hours after I did the other video. Now let's go back to today's topic, Euler's exponential and the cycles as such. So shown here previously, and it's very easy of course historically to show these things, that buying when we hit this lower confidence band here, like in this area here, and of these dips here, and of these dips here, have historically, we can see that have been very good buys. And for you that have followed me for soon 2 years, you know that I've always been buying heavily here. I do also trade other zones also, but these are the ones when I go most bananas and buy the most, because the likelihood of going down compared to up is probability of going up is much higher than going down. Historically, only one time every 4th year do we break this lower band, and that is when the bear market starts. And every time we have done that, historically, we have first broken the upper band quite dramatically before breaking the lower band. If that happens this time again, it will be quite easy to identify that top. If it doesn't, it will be trickier, but I will come back with other videos about that. Let's focus on this cycle now. Do I think that we'll go down and revisit this band again before we try for this breakout, assuming we get a normal cycle with this breakout? We can go back and look at the previous cycle and see how they looked. This is the 2017 cycle, the cycle that this 2025 cycle is most similar to statistically if you look at the R-square. Here you can see that we were also following Euler all the way from 2015, and where we are right now is in June, so we are actually in this area here, quite similar because now we're also pretty much on the line or slightly below it. That time around, we did dip down to this lower band. And yeah, I haven't recalculated the lower band, but it follows these dips kind of here. So now I cheated the lower band here. So we did go down, touch it in September. And then we dipped down again in October. And then we had the outbreak in November. And also we had the final top. If it was last week in November, first week in December, I don't remember. Because both previous bull runs have had their top just 1 week apart, end of November, beginning of December, followed by an all-season top about 1 to 2 months later. So does that mean that we will have 2 dips down again? Well, not necessarily, because already 1.5 years ago I did mention that this cycle have a different frequency. And with that I mean how many times it circles like this. Now, the number of times it goes up and down around Euler's is much slower. So you could compare this if you look at a sailing boat. If you go from London to New York, a small sailing boat will go like this, crossing the wind, where a big one will go like I've drawn here. It will shift direction more slowly, but the direction of them is what is interesting. The direction is the same. The direction of Euler's exponential is the same, but the frequency in which we move is different. So therefore, we cannot say that we believe, or I believe, that we'll dip down 2 times again, since we do these dips with farther apart. And I will go back to a separate video with about cycle timing versus cycle levels. Timing is incredibly more difficult to predict and very easy to think to predict, but in fact you might not predict the market any better than a monkey throwing dart. Just think of it like this. 2 teams are playing football, or 2 boxers going to meet each other that are unevenly matched. Then you probably know who will win. But can you tell which time we will score the goals? That is much trickier, isn't it? It's the same with predicting markets. Like on this channel, we have predicted many lows that 50k will be the bottom when we went between 50 and 70, and it pretty much was. Then I said 74k when we went sideways here some time ago, and we went down to 74.5. But I couldn't say which day or week that will happen. That is much more difficult to predict. Maybe someone can, but it is in general more difficult, and in general also information with less value. Even though I understand why people often lean to it, because you often hear about dollar cost averaging, which is a way to buy based on time. And institutions, and they often want us to do this because that gives them predictability. They know that the big mass of users, the retail, will invest every month or every week. That's perfect for them. And it's not a bad idea. Most people will do much better DCA than trying to trade. So just buy and hold the DCA, it's usually better than most people will do when they try something else. With that said, though, if you instead of buying certain times, like I buy here, because you have no idea what the price will be at those times, if you instead say I will buy at 80, at 100, so you put your buys at levels instead, that's much more predictable, and usually almost all scenarios give much more better profit also. And I'm coming to soon how we can use that together with Euler's exponential. I was going to give you one more example. I saw a video 2 years ago where someone had not a bad idea, but I will just highlight how it could have been even better. His idea was that 12 months before the halving, he will start to buy every month, and then the 12 months after, he will be selling every month, which based on historical data doesn't seem that bad idea. And I suspect it did profit. I haven't seen the channel for some time. But regardless, so that meant he bought based on time, so he kept buying like this, which means he bought to good prices here and he sold to higher prices. So I will assume he made some profit. However, would he have made more profit if instead said I will buy at 20, at 30, at 40, all the way up to all-time high, and then I sell above all-time high? Well, that would actually be better because we broke all-time high here before the halving. So he kept buying at 74, and then after the halving, if he now did what he said, he was actually selling at 50, and then of course now he will be selling with better profit. But if I would have split the market in horizontal levels like this instead, I would just have been buying, and everything I would have been selling is automatic in profit because I have to be above. I do not weigh in the factor of time. I weigh in the price action, the price level instead. And now if we zoom in here on Euler's exponential, we can use something else, or I use something else, no advice what you should do. And I mean, if I bought down here, then it's easy, but I also take out profit on exchanges, I start new exchanges. So I do have one where I'm like starting now, so I want to share that with you because many of viewers might not have bought exactly what I bought in the past, and that changes a little bit your options. And we don't know when we will touch this line again, or even if we will in this bull run. There's of course some risk or chance that we keep circling here and then break out. And next time we touch this is when the bear market starts. So one way to look at this is to split it up, to say that you have one buy zone at the line. You could have one exactly in the middle, which right now is around 94K, because this line here is 120K, right? And this one here is 100K. So down here, is 94. In the middle here is like 110. And the prediction right now, I think, is 124. And then you set something in the middle here that's like 140. And up here is 155 or something. So basically, what you can do is that you buy at these 3 points here. And then you potentially sell at these others. That's one way to do it. I use this buy strategy. But when we get above this line, I do not automatically sell when we go above, as we've done many times before. So if we go above here, I will simply set this automatic stop sell close to this line. And then when we go higher up, I move that stop sell higher and higher like this. So when we turn down, well, then the buy is sold automatically in profit. And one reason for that is that I don't know if we will break out and have a grande finish off as in the other bull runs. In that case, I don't want to take profit here if we just go banana straight up. Now, do you need to have 3 zones here? 1, 2, 3? No, you can have more. The more, the better, actually. You could even buy at every 1,000 at 120, 18, 19, 17 or so on if you want to. The important thing, though, is that you do not spend all your trading capital in this zone, because we can break to the upside and downside. So me personally, I use about 5% for each trade. Many professional traders only use 1 to 2% for each trade. Sure, it takes longer time to do larger profits, but the risk is lower. And when it goes well, when you eventually get the bottom like this, you can secure that trading profit, and then you can buy much more frequent like this. And after each trade, you wait until that trade you did is in profit. You put in a stop loss like this to protect that trade. The market goes up, you put in a new stop loss in profit. They're called stop losses, but they're stop profit, I guess they should be called. And you keep doing that. That means that all the trade below are protected. It's only the latest trade at whatever percent you use here that is at risk, in my case 5%. So in that way you can go and buy very tightly. In an uptrend like this, you're basically entering in a large portion of capital, but they're secured in profit. That's the big difference compared to if you just take a chunk and buy here half your capital and it goes down, you can buy here again. The bear market starts and you have nothing else to DCA in to buy the dip in the bear market. That's not a good way. But if you bought with 5% here and here, then you have 90% left. That's quite a different situation. But that's one way to use the levels rather than the time and be guided by Euler's exponential, where perhaps it's more likely that we go up than down and vice versa. Now, previous year, I said previous year that 2024 was a quite easier to trade. So if you think that was a difficult year, 2025 is much more difficult. And the reason I felt so was that I didn't believe in any early top, any left translated cycle, which meant when we got up here, expect a reversal. I didn't expect any early top either, which meant that when we were down here, I felt confident that we would bounce up. This year, though, I think there is at least a 50% chance that we break either of those. You might argue should it be 90% or 99%, because all previous cycles have broken them. Yeah, I know, I will come to a separate video with that. There are a number of things different this time than others. So I'm still open-minded to that this cycle continues for a while before breaking them. But the details about that I will come in another video here soon. And I've also done videos about it already, but I will do an updated one. So that was just a short update on Euler's exponential, where we are. And for new viewers, I presented this almost 2 years ago, and we have been following it for all these 2 years. And I also said when I presented it the first time online that this year is the year where we're expecting to break it, even though I just said maybe it's only 50-50. But in this cycle and previous cycle, it has been very reliable, 24 to 32 months. And we are now a little bit on overtime, so just have that in mind. And just, I'm soon coming out with a video how to validate models, why I picked Euler's exponential compared to other models. For example, Ethereum, where we have a linear regression and so on and so forth. Why I have picked them and how to validate if a model can predict or not. It's very easy to find ways to draw lines that fit existing data. but those lines you draw most of the time do not predict anything about the future, and there is a way to test and figure that out before the future happens. And that video is coming out here in a few days, so don't miss that one. Anyway, thank you for watching today. Please keep spreading the word. I really appreciate that. I love you all. Hope to see you soon again.